Good morning and welcome back to the Daily Hunt for Multibaggers. It's Tuesday, April 7th, 2026, and we're ready to dig into some fresh market insights from yesterday's data.
That's right, Ethan. Monday, April 6th gave us a pretty interesting mix. We saw a solid number of posts bubbling up, flagging several distinct stocks. And I'd say the overall market sentiment we picked up was quite polarized. A lot of strong opinions on both sides, which always makes for a fascinating analysis.
Absolutely. Let's jump straight into it, starting with Eli Lilly, LLY. This one caught a lot of attention with news of their new $149 per month weight loss pill. Analysts are projecting some really massive peak revenues, potentially $101 billion. That kind of market expansion, especially with an oral option, could be a game changer for the GLP-1 space, attracting folks who, aren't keen on injections. Their historical revenue growth at over 42% already shows what they're capable of.
Well, Ethan, that sounds promising on the surface. But when you look under the hood, the numbers tell a different story. Our AI-generated insights show a significant bearish sentiment dominating discussions. Despite that news, people are worried about cannibalization of their more profitable injectable drugs. And let's talk about the valuation. A PE ratio of 40.45 and a PB ratio of 31.26 are incredibly high. Users are calling it very expensive and overvalued, suggesting it's priced for perfection. Plus, the elephant in the room, insiders have been net selling over 2.4 million shares. That's a huge red flag from those closest to the company.
Yeah, the insider selling is definitely something to consider.
It's a major concern, Ethan. The strong net profit margin of over 31% is impressive currently, but users are predicting a race to the bottom in pricing due to competition, which could severely erode those margins. The risk here, in my view, far outweighs the speculative upside of the new pill, which frankly might already be priced in.
All right, Brooke, point taken. LLY was previously rated buy a few times, but it looks like our current analysis is pulling us in a different direction.
Indeed. Given the high valuation, the cannibalization risks, and especially that significant insider selling, our analysis for LLY leads to a clear stay-away verdict for now. This would be a downgrade for anyone who held it as a previous buy.
Okay, next up, a familiar face in the speculative world, Tesla, TSLA. JP Morgan might be warning of a 60% sink, but there's always that fervent belief in Tesla's future potential. With FSD, robotaxis, and the general innovation Elon Musk brings to the table, some still see this as a buy-the-dip opportunity. And hey, there was a small net insider purchase of shares over the last 6 months, showing some internal confidence, even if it's just a fraction.
Fervent belief and innovation aren't KPIs, Ethan. The AI is flagging an extremely bearish sentiment for TSLA, and the data is pretty stark. That PE ratio, sitting at a staggering 326.68, is almost impossible to justify against its actual earnings. We're talking negative revenue growth of negative 0.031 and a low return on equity of under 5%. Users are consistently highlighting this extreme overvaluation, calling it detached from fundamentals and, frankly, a meme stock. But the future of mobility, Brooke, the potential for autonomous vehicles, the battery technology, potential doesn't pay the bills, Ethan. Recent Q1 delivery misses and warnings of degrowth directly contradict that high-growth narrative. The stock's also showing a very high beta of 1.915, indicating extreme volatility and risk. While a tiny bit of insider buying occurred, it's dwarfed by the overall negative sentiment from analysts in the community. This stock has consistently been a stay away in our analysis, and frankly, nothing in this new data suggests otherwise.
All right, I hear you. With that intense valuation and current performance metrics, our analysis for TSLA has to remain consistent.
Absolutely. Our verdict for TSLA is stay away. Let's pivot to something that's had some interesting movement, Datavault AI, DVLT. This is a fascinating play in the real-world asset tokenization market, which is projected to be absolutely massive. The company is strategically positioned to tackle that valuation bottleneck with AI. And here's the kicker. They just reported their first profitable quarter in Q4 of 2025, with revenue growth exceeding 10x year over year. That's a serious acceleration. Plus, the insider buying is off the charts, over 86% of total insider shares purchased. That kind of conviction from within is hard to ignore, Brooke. This could be a turnaround story with real multibagger potential. I'll give you the insider buying, Ethan. That's a powerful signal, no doubt. And yes, a first profitable quarter is a step in the right direction operationally. Their TTM revenue growth of almost 36.5% is also strong. However, we've got to look at the full picture. Our trailing 12-month net profit margin is still negative at negative 2.02%, and earnings per share is at negative 0.52. That means they aren't consistently profitable on a net basis yet. More critically, the debt-to-equity ratio stands at a very high 6.435. That's a lot of leverage for a company still finding its footing in terms of net profitability. Some users are even labeling it a scam or criticizing its buzzword reliance. But if they successfully execute on these tokenization deals for copper and rare earth elements, that market cap could just explode, right? The potential here is immense if they can scale that operational profitability to the bottom line. It's about looking forward, not just at the trailing numbers. Forward potential is critical, but so is financial stability, Ethan. The high debt and current net unprofitability means there's substantial risk. While the insiders are clearly bullish on future execution, a general investor needs to approach this with extreme caution. The news about their profitable quarter is positive, but it needs to translate into consistent, sustainable net profit to truly justify the current valuation relative to its risk profile. DVLT has bounced between stay away and speculative gamble, and most recently, cautious buy. I think that cautious buy is still on the table, Brooke, given the undeniable potential and the insider confidence. Absolutely. For those with a very high risk tolerance, perhaps. But for the general audience, the risks are still significant. However, acknowledging the strong insider sentiment and recent operational improvements, it warrants a closer look for specific investors.
So, to land on a definitive verdict for DVLT today, weighing the explosive potential against the very real risks,
I'd say we classify DVLT as a cautious buy. The internal confidence and operational improvements are notable, but the underlying financial risks demand careful due diligence.
All right, team, let's quickly round up our AI-generated insights for today, April 7th, 2026. Here are your top candidates for deeper analysis. Investigate as buy. None. Investigate as cautious buy. Datavault AI Inc., DVLT. Investigate as speculative gamble. Tesla Inc., TSLA. And that's our deep dive for today. Just a quick reminder before we sign off. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advice before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers.
We'll catch you next time for more insight.